Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. What I've been talking about over the last series, and it's been a long series, it's one I've put off for a long time, as many of you know. It's the area of long-term care planning, long-term health care planning. People have asked me on this radio show since it began, would I please do a series on long-term care planning? What that means to me is planning for your assets, planning for if you're covering expenses, planning for family, contributing to helping care for an aging parent. Any kind of planning regarding long-term care to me means someone is living with assistance. They need help with maybe cognitive issues, which is remembering things, maybe the memory's going, or physical things. So I put this off, this series, because it's so hard. It's the single most difficult area in all of the areas I deal with in financial planning for me. The reason is there are so many different choices and alternatives, and none of them are perfect or waving a magic wand like I would prefer when I'm trying to find or search for solutions for families and business owners. So that's why I've put it off for so long. So I finally bit the bullet. And after the first of this year, 2015, I decided I'm just going to grind down and work with all of you who are listening and getting these shows on video through email and help you page by page, link by link, understand this area of long-term care planning. So we've gone through the show, and I want to pick up where I left off last week. We're in the stage of shopping for long-term care insurance. Now, again, I've gone through different stages. We're going to continue after the long-term care insurance, dealing with other alternatives, whether to buy life insurance with long-term care riders, annuities with long-term care riders, whether to go to the attorneys and work on asset protection strategies instead of insurance at all. And that may be of interest to some of you who are medically unable to qualify for insurance or just have the unwillingness to. Some people say, why should I pay premiums for insurance when if I never use it, all that money will have gone to waste? Other people say, I should self-insure, which means use all those monies that would have gone to premiums, set them aside or bank them, build up your own reserve. That'll teach those insurance companies, right? Because now you have the money to take care of your own nursing home expenses. And if you don't go into a nursing home, you get to keep it, you or your family. Well, add up the dollars, folks, because if you're looking at what the premiums would be, and I'll get into that today on some of these long-term care policies, I'll give you some estimates. If the cost of care premiums over 10 or 20 years, let's say we're 55 years old, we're considering buying this for 30 years. We might not need it until we're 85 years old, or may never need it, let's say. So we've spent it, theoretically, these premiums, given $4,500 or $5,000 a year to an insurance company. And we've done that for 30 years. So we look at that and we say, we've given them $50,000 over 10 years and not received a dime. And the next 20 years, if there are no rate increases, which there probably will be, even though it's quote-unquote level term premiums, we can't trust that. We've learned that from history, even recent history. So we spend $5,000 a year for 10 years is $50,000. From age 55 to 85 is 30 years, though. So we've spent a grand total, wasted, as some might call it, $150,000 out of our retirement assets per person. What a waste, right? And you'd look at that and say, if I need to cover myself and my spouse, that's $300,000 out of our retirement budget that's been wasted up in smoke. Smarter to self-insure, you might say. And I, as a financial advisor, just look at it both ways. I'm a financial planner saying, let's look at the numbers. Whether you go into a nursing home, whether you don't go into a nursing home, whether you buy a policy, whether you don't buy a policy. So we just do math and then factor in the odds. So if I look at the situation that I just explained, that's $300,000 paid over a period of 30 years. Now, you and I well know that if I had paid a premium 30 years ago, I can afford that same premium now way easier than I could have 30 years ago, right? And so could you, because our incomes are higher. So yes, inflation is higher, expenses are higher, but our incomes are higher. And I think all of you listening to the show and watching the video will agree you're making more than you were 10 and 15 years ago as a rule, for most of us, not all of us. So if that's the case, we want to factor in, if we're paying a premium over the next 30 years, probably the last 10 years worth of these premiums will be less of our overall budget than they are today. But let's take straight numbers. $300,000, both of you live till you're 85, don't go into a nursing home, both of you pass away after 30 years at age 85, and all that money was wasted. The alternative, one of you might have gone into a nursing home at age 80. So I look at that situation and I say, we've paid premiums for 25 years. And let's say with pay raises or rate increases, maybe we paid the whole $300,000 because maybe there was a rate increase that circumvented that. So even if I was out the whole $300,000, folks, the cost of a nursing home today, on average, for a skilled nursing facility, exceeds $10,000 in many areas. $10,000, not a year, folks. $10,000 a month to get the care for your loved one or your spouse. It costs, in today's dollars, not 30 years from now, but today's dollars, in excess, in many cases, over $10,000 a month, which is $120,000 a year. That's a lot of money. And in 30 years, no, forget that, 3 years, that's $360,000 just in a small snapshot. If one of the two of you, if you're married, or one of the two of your parents needs in a nursing home for only 3 years, it could theoretically wipe out as much of their investment assets as the premiums would have taken 30 years to wipe out. Now here's a difference. Not that one's right or wrong. I understand that if you save the premiums and then put them aside, they theoretically will grow. So you will have earnings, potential growth on those assets. So I get that. I also understand that if a person is in a nursing home for 3 years only, that uses up what I just mentioned in this example, the whole 30 years worth of the cost expenses. I also realize that from my very first payment to the insurance company of that premium, $5,000 a year is about $450 a month from my very first monthly premium. I might make those premiums only 5 years, but I'm covered from day one for the whole amount of coverage I purchased. That can be different for all of you. But if I buy the coverage, I'm insured from day one. I might not have to pay $300,000 over the 30 years. But don't you wish you did? Don't you wish you had to pay the whole 30 years and never use it? Folks, there aren't many people in a nursing home I know that are there in a skilled nursing facility because that was their retirement dream or goal. And I think you'd be the same. I don't want to go into a nursing home, you'd say, and you'd talk to your spouse and your family, please never send me to a nursing home. But the fact is, many of the people who are currently in a nursing home now might have said those very same things to their family members. But the family members, by the time the person's needs got so exacerbated, they had no choice but to put their loved one into a nursing home because that's the place they could get the best quality of care for that loved one. So what we're looking at is you're covered from day one if you buy the insurance, but you get earnings from day one if you don't. You put it in a bank CD, let's say, or wherever you put it. And you look at that growth potential versus the maximum coverage potential from day one. And you have to weigh the odds. I'm not saying one is better than the other. What I am saying is if you do have the insurance and then need the type of care, the insurance premiums are dwarfed by the amount of cost of care. If you don't buy the insurance and need the cost of care, you're paying dollar for dollar, month by month, out of your personal assets to pay for that care. So the premiums are pennies on dollars, it's sometimes referred to, and the self-insurance is paying dollars for every dollars. There are no discounted dollars in use there. So I don't know if that example helps, but I can tell you this. Anyone who plans for long-term health care expenses in advance is well advised to consider insurance and transferring that risk to another party to pay the full freight of the cost. For maybe you only paying 5% or 10% of the total cost of care. Because 20 and 30 years from now, this $10,000 a month cost in nursing homes right now, if inflation continues the way it has, will be $20,000 to $30,000 a month 20 or 30 years from now. And if it's $30,000 a month, that's $360,000 for 1 year of care. That is over $1 million of wasted assets 30 years from now for just 3 years of care. That some people would say, if they buy that same level of insurance today with an inflation guard rider, they may have saved themselves hundreds of thousands of potential dollars later by wasting, as we call it, smaller dollars all along the way that they can afford to lose to not lose all the rest. So that's our evaluation, folks, as a financial planner. And now you can begin seeing why this is my hardest area in all of financial planning to solve. Because it is. Let's talk about shopping for the insurance. Last week I touched on that, and I'll share a couple more strategies with you when you shop, because it seems like it would be so easy. Just shop premiums and coverage benefits. By coverage benefits, most people think that means coverage limits. How much will they pay a month or a day? How much will these insurance companies pay? But I, as a financial planner, look at the situation and say, okay, folks who want to do it yourself, get online, compare policies back and forth. Have you asked all the right questions? You'll say, yes, I'm comparing each one of them to $200 a day benefit for 3 years or 5 years or whatever you're comparing. And I'll say, okay, did you pick which one's best? Yes, we found which one's best. We just applied for it last week. I'll say, that's wonderful. You've made a decision. And I'll talk with another family, and they say, we compared them all, and we just decided to self-insure. And I'll say, that's wonderful. You made a decision. And I'll talk with another family who says, we shopped all the insurance, and we carved out a portion of our assets instead. And I'll say, that's wonderful. You've made a decision. And then I'll follow up with, have you asked all the right questions while you were doing that analysis? And they'll say, what do I mean? And I'll say, did you look when you checked with the policies on whether they are Pennsylvania or state partnership policies? And have you looked to see, are they tax qualified or non-tax qualified? Did you look at each one to see, are they indemnity based reimbursement based, or disability based? And of course, I've lost most of you listening, and I lost everyone that I'll ask that question to by this point. And I haven't even gotten into the meat and potatoes of how I shop for long-term care insurance. So they'll say, what are you talking about? And I'll say, do you understand if you have a partnership policy in many states, every state's different, but it's a program that states have enacted, some states, to help protect, I'll use a rough example here, an equal amount of your personal assets to the amount of coverage that you purchased. So if you buy a $300,000 maximum benefit policy, that's the maximum they'll pay out. In some states, you may have exempted the first $300,000 then of your other assets should you run through all those benefits of the nursing home insurance policy. The state Medicaid and all says they won't touch the first $300,000 of your assets. They'll protect an equal amount to whatever you purchased long-term care insurance for. Whoa, does that factor into the decision now of self-insure versus buy some insurance, doesn't it? Because that in essence doubles the impact of if we have an insurance benefit, doesn't it? Well, if you don't know to ask the questions, you won't know to factor that into your analysis. And then I talked about the tax qualified. And I'll get into that in as much detail as people want on the show or videos. Any of you receiving my videos, just email us. If you're not, we'll put you on our email list. We send them out. You could send the emails in. You'll see it online and you'll see it on the radio show. But you can email Driscoll at SagePointAdvisor.com, and I'll get you on our list and we'll get these out to you because I'm going through a lot of details. And I'm here available for help too, for those of you who would like. But when we look at this, the next one, tax qualified, means a portion or all of what you pay for long-term care insurance may be tax deductible on your income tax return. Well, that mitigates or further reduces the potential cost of that premium, right? So if you're spending $4,500 a year or $5,000 a year per person, for example, but it's fully tax deductible, in your case, everybody's case is different. You have to itemize on your tax return to be able to take the deduction. It has to exceed either 7.5% or 10% of your adjusted gross income, depending on your circumstances, after 2013. But they're just details, folks. This is about asking the right questions. If all, any, or a portion of your long-term care insurance premiums are tax deductible, would that help factor into your decision on whether to self-insure, do nothing at all, carve out your own assets, or pay insurance premiums? If that further whittles down the cost of the insurance premiums, would that help factor into that decision and help you make a better decision? Well, sure it would. So, are they all Pennsylvania or whatever state partnership policies you're shopping, are they all tax deductible or tax qualified? Some of you will say, what about my old policy that I have from years and years ago? What are you saying, Jack Driscoll, is tax qualified? Well, any policy that is labeled as federally tax qualified was issued after January 1st, 1997. So and I'm not saying any policy after that date is tax qualified. I am saying any policy after that date is designated either federal tax qualified or not. So any policy that's purchased after that date must be designated federally tax qualified, or those premiums are not income tax deductible on your tax return, again, if you itemize. So some of you say, well, I have a policy that I bought in 1995 or 1990, and they're older policies. Do I have to get rid of those and get into one of these new tax deductible policies if I want to deduct the premiums? And fortunately, the answer is no. Most, not all, of long-term care policies issued prior to January 1st, 1997 were grandfathered in as being federally tax qualified, even if they don't meet the definitions that policies after that date would have had to meet. So get with your financial advisor if you're paying these premiums and see if you're able to deduct those premiums. Also, any of you who have a nursing home insurance policy already, find out, are these Pennsylvania Partnership approved or not? Because the policy has to be designated to be able to be approved by the state for the Pennsylvania Partnership or whatever state it is, or the equal or pro rata portion of the assets would not necessarily be protected like I just explained. You see the difference? And the third example I said, and I have many more, I'm going to cover them on the show. I am bound and determined now to get through this series, however complex it is, and why I've put it off so long, to help each and every one of you understand that you are not helpless when it comes to planning for your and your loved one's future if someone needs to go into a nursing home or needs nursing home care at home. Again, you can design programs to be anti-nursing home programs. Provide the funding and the resources to help prevent the person that you love from having to go into a nursing home. It requires resources. But remember the third one I said, indemnity-based, reimbursement-based, or disability-based benefits? Wow, who knows to ask these questions, folks? Email me. I'll help you any way that I can. I told you before, and I'll tell you again, you have to build a team of financial, legal, and tax professionals to help guide you through these most difficult areas, or you're going to end up floundering on your own, or at least one out of every three of you might, because the statistics say that's who might be entering the area over the next period of retirement needing some form of long-term care. But here's the difference in these benefits. Reimbursement-based means someone who triggered the need for this coverage but can only get paid back the amount they're actually spending on the cost of care. Indemnity-based means someone who has triggered the coverage benefits is receiving the type of care that is qualified. But indemnity means the companies, as a rule, will pay up to the maximum daily benefit or monthly or however you've bought it, benefit for that type of care for those services, even if those services are not costing that much. Disability benefit, which I hardly ever see, is a benefit that is triggered when you have the condition and aren't even receiving services, or are, but not even having to receive services and still get the full check payable to you. So they're different company premiums, and one would be high when you did your shopping and another would be low, and they're both for $200 a day, and you'll pick the lower one. And here you might have chosen one that only reimburses versus one that's indemnity and pays the full benefit out. I'll get into this in other shows. Please stay with us. It's a long series. It's a hard series, but it's one that many families are running into and could have prepared to avoid the financial hardship. If they just stick with the show and hear all the different series, believe me, I'll help equip you for making much better decisions than you can make on your own. All right, we're out of time. We'll be back again next week. Thanks for tuning in to another edition of All Things Financial.
You've been listening to All Things Financial with your friend with the answers to all financial matters, Jack Driscoll of Driscoll Insurance and Financial Services. Securities and investment advisory services offered through SagePoint Financial Incorporated, a registered broker-dealer and registered investment advisor and member FINRA and SIPC. Driscoll Insurance and Financial Services is not affiliated with SagePoint Financial, Inc. or registered as a broker, dealer, or investment advisor. You can reach Driscoll Insurance and Financial Services Incorporated at 412-833-1500, and they are located at 2738 South Park Road, Bethel Park, Pennsylvania, 15102.